The big six Canadian banks need no introduction, everyone. They consistently outperform the overall Canadian market. They're very, very big, well-managed old banks that have been paying dividends, which are profits, for a long, long time. A couple of them, or one of them, over 100 years now. It's pretty crazy. So the big six Canadian banks need no introduction. I find it funny that there's always YouTubers and other investors that are trying to, which ones are you going to have in your portfolio? Go with TD, or go with Nova Scotia, Bank of Nova Scotia, or CIBC. I think the best idea, the easiest idea, is to save on time and energy, of course, as well, is just to own all of them. So then the $1 million question becomes, what is a very efficient way to own the big six Canadian banks for different investing goals? Some of you might just want a basic equal weight ETF that has the six banks equally, no leverage, no covered calls, nothing fancy, just a basic option. Some of you, of course, most of you watching, are income-oriented investors, so you want yield, you want to maximize yield. So then you would get a Canadian bank's covered call option or covered call style ETF. Then there's also leveraged versions without the covered calls. So that's in case you're really bullish on the banks, you want to add a little bit of leverage so you could really get that extra boost in returns for the long term. So you have a lot of options, but the good news is that there's one particular ETF manager in Canada that's really a specialist when it comes to financials in general, but more specifically the Canadian banks. Of course, I'm talking about Hamilton ETFs. And with their launch of two new Canadian banks focused ETFs, you can literally consider this ETF provider for whatever your investing goals are when it comes to investing in the six banks, because they literally have an ETF for every kind of objective. And today we're going to analyze all their Canadian banks related ETFs for different objectives, so you could really decide based on your investing goals and your investing style which one is the best for you. Not only that, but again, we're going to talk to Rob Wessel, a returning champion, co-founder at Hamilton ETFs, Canadian bank specialist. He used to be a top performing Canadian bank analyst back in the day, and we're going to discuss Canadian banks in general. We're going to get his take on what happened with the US banks fiasco, and we're going to talk about some of these new ETFs as well, and all their ETFs related to the Canadian banks, so you could be well informed and choose which one is best for you. Let's get started. All right, so I will introduce their brand new ETF, HEB, the Hamilton Canadian Bank Equal Weight Index ETF. Just like the name says, this is going to be your basic option, no leverage, equal weight index, which means you literally have an equal weight of the big six banks. Here they are right here. Very big fund already, over 500 million. And of course, a combination of the six banks will typically get you an average dividend yield of about 5%. So they are saying that this is the lowest cost Canadian bank ETF, the lowest management fee at 19 basis points or 0.19%. So let's take a look at what I think is its biggest competitor, ZEB, the BMO Equal Weight Banks Index ETF. And you could see that the management fee, the max management fee is 0.25. So it is much less with HEB for the exact same thing, right? This is the exact same thing. It's an equal weight banks index ETF. So you will save on management fee. I know what your next question is going to be. What about the MER? That's the management fee, but what is the MER, which is everything put together? Well, we're going to talk to Rob about it later, but spoiler alert, so the BMO one is 0.28, and for HEB, it's going to be about 0.25. So you are still saving a tiny bit in fees, which could add up over time, of course, for long-term investors. So HEB is really your basic option, lowest cost or lowest fee Canadian bank ETF right now on the market, monthly distributions, no cover calls, no leverage, your basic option. They also have HCA. So HCA is another, I would call, basic option from Hamilton ETFs, except it's a little different. It's called the Mean Reversion Index ETF. So what this basic ETF does, you'll notice that the yield is a little bit higher. It's also going to have the six banks as well. But what this index does, because this ETF is trying to track an index, is that they constantly rebalance the weight. It's not equal weight. They constantly rebalance the portfolio, and they invest 80% of the portfolio in the three banks which have recently underperformed, So they're not doing too well compared to the other three, and only 20% in the three banks that are doing really well. So basically, the premise behind this is the six banks are all really good long term. Some of them could underperform or outperform others in a certain amount of time. So what this does is trying to capture, the underperforming one, and it turned the underperforming banks. And it turns out that not only does it have a little bit of a higher yield, but it turns out that this strategy, for the longest time, you see the graph here, the mean reversion strategy, which is the red graph here, outperforms if you would have the banks in an equal weighted ETF. So you have two options. HCA, by the way, the management fee is slightly higher, 10 basis points higher, so it's 0.29 instead of 0.19. I'm assuming the MER is going to be, with the MER, probably 5 or 6 basis points a bit higher. So as you could see, it still has the six banks, but you're going to have the majority in the banks that have recently underperformed. So in this case, it's going to be CIBC, TD, Bank of Montreal, and then the banks that have done really well lately, Royal Bank, Bank of Nova Scotia, National Bank of Canada, will have the smaller position. And this could alternate, this could change at any time, but it does turn out that it beats the overall, the equal weight ETF. So these are going to be really your two basic options, everyone. I'm assuming, most people are just going to go with the equal weight, and now you have HEB for that, which has the lowest MER in Canada in terms of equal weight Canadian bank ETF. But there's more options. Of course, if you're an income investor, there's HMAX. This just came out a few months ago. It's the Hamilton Canadian Financials Yield Maximizer. I've already done a review of this ETF in detail, so I'm not going to really go over it here. So you can watch that video if you want, but this is where you're going to get it's going to be the highest yielding financials ETF in Canada. Just keep in mind it's 75% in the six banks. It's not just the banks. It also has a little bit of exposure in the life insurance companies, so it is financials. So there's a bit of Sun Life, Intact, and Manulife, as well as the biggest asset manager, Brookfield Corp. So it's about 75% in the banks. Very, very high yield. Again, check out the video that I did. You might have noticed a slight distribution decrease lately. Keep in mind, this is a covered call ETF, so the distributions can vary based on volatility. But why did they reduce it recently? I'll ask Rob all about it in just a few minutes. Before that, I also want to go over there are two other leveraged ETFs. So now there's HCAL. So HCAL is basically HEB with 25% leverage. So obviously it's going to have 25%, approximately 25% more yield. And it turns out that HCAL is the top performing in terms of total return Canadian bank ETF ever. So if you scroll down, it's very, very simple. The concept, guys, it's just going to hold HEB, plus it's going to have 25% leverage, right? So you have a 25% higher total return over time, higher 25% higher distributions as well. Also very, very big fund, so nothing to worry about when it comes to liquidity and volume. So HCAL is the top performing Canadian bank ETF, also managed by Hamilton. So let's say you're very bullish and you want the equal weight, but you don't mind taking a bit of leverage. 25% leverage is very modest. I definitely would go to HCAL. If you ask my personal opinion, for total return, HCAL is the way to go. For maximum yield, HMAX is the way to go. But of course, you can mix and match. There's nothing wrong with that. I will also mention that they have HFIN. So this is another leveraged Canadian financials ETF, just like HCAL. But it's not just the banks. There's actually, it's about 60% banks. But it's also going to have other things as well. Like Brookfield is there again. The insurance companies are going to be there. Manulife, Intact, Sun Life, Great-West Life, and Fairfax Financial Holdings, which I guess was recently introduced because I had no idea it was there. But this is not just the banks, but it is financials. It is leveraged 25%. So if you want a little bit of diversification with the Canadian financials, you don't just want the banks. There's 12 companies here instead of 6. HFIN is a great option. And I will have mentioned that in HDIV, Hamilton's multi-sector all-in-one covered call ETF, which is also leveraged 25%. There is both the HMAX ETF and the HFIN ETF, which is a really cool combination because HMAX is let's get the maximum yield. HFIN, no covered calls, it's this one, let's get the maximum total return and growth over time with the Canadian financials. So let's say that you are not comfortable investing only in a specific Canadian banks or Canadian financials ETFs. Hamilton has also another great option for you, HDIV, because it's about 30% in the financials, but it also has 15% in energy, 15% in gold, and a little bit in utilities, healthcare, and technology. Just remember that this is primarily a covered call product with a nice approximate 10% yield right now. So enough of my time to talk now. Let's talk with Rob Wessel. Let's figure out what's going on with the Canadian banks. Where are they headed? What are the risks? Are they a great buy now, the Canadian banks? Are they cheap? Are they expensive? What happened in the US? And we'll discuss all these ETFs as well. Let's get started. All right, everyone. Welcome back to the channel. I have with me again, Rob. Nice to see you again. Long time no see, by the way.
Nice to see you too.
Back on the channel. Thanks so much for doing it. Today, we're not going to talk about HYLD. We're going to talk about the Canadian banks, the Canadian bank landscape a little bit in what happened in the US banks. I'm curious to know your thoughts. And then we'll go over some of Hamilton's ETFs, including Canadian banks or financials ETFs, which basically is your firm's specialty, including the new one you just launched, HEB, which is actually the lowest management fee Canadian banks ETF right now on the market. So we'll talk all about that. How's it going, Rob? Doing good?
Yeah, very well. Thank you. Thank you for having us. It's always exciting to be on the channel.
Yeah, glad to have you. And in case my audience members don't know, you're actually Canadian banks analyst, you're an expert. Tell me a little bit about your expertise on and your background reviewing Canadian banks.
Yeah, in my past life. So I've been deeply involved in the Canadian banking sector on an analytical level for about 28 years. I worked in investment banking, worked in corporate finance, but I was a top-ranked Canadian bank analyst each and every year for many years, and then ended up at Hamilton ETFs, and our firm has specialized in financial services for its entire history. So add it all together, and I guess we've got a good 20. I got about 28 years and some gray hair.
So you know what you're talking about when it comes to the Canadian banks, essentially, for sure. I'm gonna say that. I know,
Okay.
I'll say that. So all right. So what is going on with the Canadian banks landscape right now? Are they? Would you say that they're cheap? Are they expensive? How would you describe the overall Canadian banks landscape?
Yeah, so the Canadian banks are actually quite inexpensive. So they trade at less than 9 times forward earnings in an environment that was, say, more normal, and there was less concerns about economic risk, interest rates, things like that. I think when the ROEs, return on equity, is over 15, you'd probably look for PE multiples somewhere between, maybe call it 10.5 to 11. Right now they trade at less than 9. So they're very inexpensive. So what we like to tell everybody is, these are great companies over the long term. History has been very kind to people who bought the Canadian banks at less than 9 times forward earnings if you're a long-term and patient investor. The other thing we always remind everybody is you don't get these inexpensive valuations when there's rainbows and sunshine. By definition, you get these valuations when there are storm clouds. The real question is, are storm clouds, to use a metaphor, serious enough to dislodge or affect the foundation, whether it be capital or earnings? And so that's really the central question. If you think these companies are going to be fine, they're going to do well over a 4-year period, then these are very, very compelling valuations. If you think the world is going to fall apart, well, then you think they're fairly valued.
Okay, so what opportunities do you currently see with the banks right now? And maybe you could talk a little bit about some of the risks as well.
Yeah, so on our website, hamiltonetfs.com, at the beginning of the year, we always write our outlook for the year. So in January, we wrote a piece, opportunities and risks, or risks and opportunities in the Canadian banking sector. And so when you entered the year, because valuations were still very low at the beginning of the year, there were quite a few opportunities, and the opportunities really were that credit losses would be less than as expected. This is very, very important, which I'll talk about in a moment. The second is that capital markets, these big investment banks, were generating very mediocre revenues in the previous couple quarters. If they started to recover, that would be pretty important. And just generally speaking, if you could get some sense of normalcy or, around monetary policy, there was a chance that you could see higher PE multiples, which brings you to the risks. Obviously, right now, I think it's reasonable to assume we're either in one or there will be a recession. So I think that, the analysts are really forecasting in their estimates a hard landing. So if it's a soft landing, that's going to be great. If there was one number you could leave everybody that would kind of crystallize everybody's thoughts is, and without getting too technical, the analysts who are building the estimates and consensus, they're looking for loan losses of just shy of $12 billion for the year for fiscal 24. And so for fiscal 23, excuse me. And the banks last year had losses of about 5 billion. So they're looking for, the analysts are forecasting losses to be up more than 100%. And by the way, the following year, they're looking for about 14 billion. So it's not whether credit is going to deteriorate. I think everybody knows that. That's not really the question. The question is, are they going to rise more than 12 billion? And when you look at Q1, which was just reported, they came in at around, give or take 2 billion, if you exclude reserve builds, which annualizes to 8, not 12. So at the end of the day, the analysts have built in some really solid conservative numbers that form the basis for that 8.9 times forward. So I think when you're looking forward, that should give you a lot of comfort that a lot of bad news is already built in. But that's not having said that, if there's some big geopolitical event or some sort of unforeseen event happens, like Silicon Valley Bank, which we're going to talk about in a moment, then they could languish here for a little while.
Yeah, that makes sense. I mean, I don't dig deep in the headlines, the bank's quarterly reports. What I really do remember, now that you triggered my memory, what I do remember reading is credit or defaults not as high as expected. I think you kind of just said that. The banks popped. And the other thing I saw is that they had a lot more revenue with trading. So broker, a lot of people, especially retail investors, they all want to get in the stock market. There was an explosion of trading fees because, as we know, the banks do have higher trading fees than the discount broker. So very interesting. Thanks for that summary. I'm always bullish on the Canadian banks personally. I think they're extremely well managed. Speaking of well managed, the US banks did make some headlines recently. I kind of understand it. I wanted to understand why SVB went down, but what I want to ask you is, and you're a banking expert, why does this stuff always happen with the US? Why are the Canadian banks, you never hear this stuff from the Canadian banks? Is it because they're better managed? Is there better laws and regulations? Maybe we could start with, what do you think happened exactly on the US banking side?
Yeah, so all good questions, all extremely relevant to where we are today. The first thing I would say is Silicon Valley Bank, and the ticker was SIVB, so I'll refer to it as SIVB for simplicity. It was a very idiosyncratic institution. It's this crazy, it's very interesting. By the way, a highly, highly successful bank over the past 10 years. We've owned it many times over the years. It's been great. We did not own it in our US small mid-cap financials ETF, which, by the way, is by far the top performing financials ETF in Canada by a significant margin. We did not own it in that fund. So, but kind of, because they deal with Silicon Valley, when COVID hit and everybody thought we were never going to go outside and we were going to be wedded to Zoom forever, as we all know, tech did very well. Silicon Valley's deposits actually went up 100%. So for the benefit of your viewers, if deposits had gone up 4%, that would have been great, not 100%. So that was a crazy set of circumstances all by itself. Then the next thing they did is they invested all that extra cash into longer date securities while rates were low. And so that therein lies sort of that seeded the problems when interest rates went up. They ended up with big unrealized losses on bonds, and then they did an underwriting. I think but what's really fascinating about this is what happened with Silicon Valley Bank was a modern day run on the bank. So if you watched It's a Wonderful Life, that was an old school run on the bank. This was a modern one. So once you get into the issue of confidence, I think it takes away from people like us who spend our time studying the financials and what's their capital and reserves and all that stuff, and just say, well, that I don't know what's going to happen, because no bank in the world can survive a run on the bank, because by definition they're levered 10-1. So you have this crazy thing, but at the end of the day, Silicon Valley Bank, as big as it was not systemically relevant. So this was all going to blow over because the other banks have different sources of funding. It was very idiosyncratic, and this was all going to kind of work its way out. I know you asked, is this something that, that Canadian banks seem to have had done better? I think that's true, but it's only true since the global financial crisis. The Canadian banks have had lots of problems over the years. So I'm not here to rewrite history. They've definitely had problems worse than the U.S. banks in prior years, but more or less since the global financial crisis, since they became more integrated and more diversified, they have been more conservative. And I think, as it sits today, you have 6 very, very strong companies. Capital is near all-time high. Earnings are near all-time highs, which people kind of forget. They're trading at less than 9 times forward, but earnings are near all-time highs. Reserves are near all-time highs. Like, the fundamentals of the companies so far have been extremely resilient.
Excellent summary there. Yeah, bank runs always make me laugh because,
Yeah,
like you kind of alluded to, it could happen to any bank right now. If there's
yeah,
enough fear and sheep herd mentality, and that's kind of what happened to SBV.
yeah,
Unfortunately, they made the bad mistake in investing in those government bonds in a low interest rate environment. I'm sorry, and of course, when interest rates spike, those bonds lose value, and
yeah.
probably started some rumors, started a bank run, and that's all she
Yeah.
wrote.
Well, also their client base was under great stress, so they were taking out deposits to cover the payroll. All these tech companies and venture capital firms,
Right.
and then because they're all in Twitter, a very tech savvy, it just all went against SIVB.
All
It's pretty
right.
crazy, actually.
Yeah, it was pretty crazy. I was seeing those
Yeah,
lines, and there was like all young people in those lines. I'm like, what is
yeah,
going on? But anyway, anyway, we could talk about this for a long time.
yeah.
But thanks for sharing the information. Always like talking to a banking expert about this stuff. So let's get into Hamilton ETFs, financials ETFs. You guys just launched one. This is your core competency, financials, and you guys just launched HEB. So
Mhm.
HEB is an equal weight, very simple equal weight Canadian banks ETF, and it actually has the lowest fee at 19 basis points, which is 0.19%. So tell me a little bit why you guys decided to launch this ETF. What is it all about?
Yeah. So we wanted an equal weight index ETF. So it's based off of an index. It's based off the exact same index as other equal weight ETFs in Canada. We also wanted to have the lowest fee. But we have a lot of people who follow us, who go to our website, who are interested in the Canadian banks. We have a mean reversion Canadian bank ETF. That's not for everybody. And so we wanted to have, for those who didn't want a little bit of leverage. I know we're going to talk about HCAL in a moment, but just wanted a plain vanilla Canadian bank ETF. We wanted to offer that to them. So we have the lowest cost Canadian bank ETF, management fee of 19 basis points. I would also point out it's an extremely large fund. It now has over 500 million of assets under management. So we have the lowest fee and one of the largest Canadian bank ETFs in HEB, and it's among many of our offerings.
Yeah, and just to give my audience some perspective, the one I think is the biggest one or the most popular competitor is at 0.25 management
Yes, that's
fee,
right.
25 basis points. So, of course, this question is coming. I feel it because now I know what my audience asks,
Yeah.
is going to ask anyway. That's the
Mhm.
management fee. What can you say about the MER? And just to give context, the competitor's MER is 28 basis points.
Yeah, so we have ours is 25, so it's just a small amount higher than the management fees. So it's still on an MER basis, it's still the lowest cost Canadian bank ETF.
Okay. Awesome. I'm sure people were going to ask you. So this is
Yeah,
really is the lowest cost equal weight. If you want the six banks equal weight, nothing
that's
fancy, no leverage,
correct.
HEB is for you. You are saving a bit on management fees, which we know makes a
Mm.
difference long term on performance. So
And when you engage with us, I mean, on our website, we have a lot of commentary. We provide a lot of support to the people who invest with us. So investing with us, we also help give you, a lot of support and commentary around how to think about the sector.
yeah, yeah. So that's HEB, but you guys also have other ETFs. You have HMAX, you have HCAL. So what I'll do is I'll just briefly
Yeah.
share this picture because I find it really summarizes perfectly and nicely all your Canadian financial style ETF. So HEB is the new one. We talked about it already. If we can, I think let's talk about a little bit about HCAL. So HCAL is
Yeah.
basically it used to be HCA used to be in it and then
That's right.
25% leverage, but now HEB is in it. So you switched HCAL from a mean reversion strategy, which is basically what HCA does. So if you
Mhm.
could just quickly explain what is HCA or what is the mean reversion strategy?
Yeah, so mean reversion back tests extremely well. HCA, the Hamilton Canadian Mean Reversion Index ETF, has 30 years of back testing. It's all on our website. It's a very good strategy. It doesn't work all the time, but it does have very good history. HEB, though, we found that people who owned HCAL, so just for the benefit of your audience, Adrian, HCAL invested in HCA. We did a unit holder vote to have it invest in HEB instead. And the
Instead.
reason we made that change is because we found that people who are in HCAL overwhelmingly were in it because of the modest leverage, not because of the mean. Now, there was some who were in it for mean reversion plus 1.25 or times 1.25. But by and large, all we did is we somewhat purified HCAL so that if you wanted generic Canadian bank exposure and you weren't interested in mean reversion for whatever reason, but you really like the idea of having a modest amount of leverage because the power of compounding, as long as you think the Canadian banks are going to go up, you get the power of compounding, especially over 1, 2, 3, 4 years. HCAL is the top performing Canadian bank ETF by a fair margin.
Mm-hmm.
And you get 1.25 times the underlying yield, which, as you can see on the screen now, is about 7.6. So we like mean reversion, but we recognize not everybody was as interested in it as we were. So HCAL, people were in it very much because of the modest leverage. So we just wanted to purify the fund and put in an equal weight index ETF. We also wanted something for people who didn't want leverage and also didn't want mean reversion. They wanted something, again, more generic. So we felt we rounded out the offering by adding HEB.
Yeah, you guys have everything now, right? So if
Yeah.
you're a basic investor, you don't want the leverage, you have the HEB, which is the equal weight, you have the HCA, which is the mean reversion. And correct me if I'm wrong, I think they both have the same management fee at 19 basis points. Is that correct? Or is
Uh,
HCA a bit higher?
no, HCA is 29.
Okay, HC is 29, so it's a little bit higher, but you get that mean reversion strategy. Good if you understand it, if you think it'll outperform long term.
Yeah.
Slightly higher yield as well
Mm.
than the HEB. So that's if you're a basic investor. If you want a little bit more, if you want some leverage, you go with HCAL. That's basically HEB with 25% leverage. Of course, long term, this ETF has proven that leverage is your friend. It's a top in terms of performance. HCAL is king when it comes to the Canadian banks. You also have
Mm.
HFIN, but that is not just the Canadian banks. That has the life insurance companies as well, and I think an asset manager. So a little bit more diversified, not just the banks, but same concept,
Exactly.
25% leverage. And now I want to talk about HMAX. So this is obviously I'm an income investor. I like HCAL. Myself personally, I actually own HMAX out of all of them.
Mhm.
So tell me a little bit about HMAX. First of all, I love the name, the Hamilton Canadian
Yeah.
Financials Yield Maximizer. So obviously, your intention is to really maximize yield. It is the highest yielding Canadian financials ETF. It uses a covered call strategy, the only one out of all of these that use that. Tell me a
That's
little
right.
bit about HMAX.
Yeah. So just to clarify, HMAX has no leverage.
No leverage.
It is a cover call strategy. So one thing that we thought, Adrian, and you would understand this better than virtually everybody that we deal with, is in Canada, we'll call it your generic covered call ETF. Not all of them, but let's just say a generic Canadian covered call ETF, not even necessarily financials, would probably write on, call it 30, 35% to the fund, and they might be, 5% out of the money. And in those, again, rough generalizations, you might get 200 basis points or 2% higher yield than the underlying dividends. So tack on the dividend yield plus 2%, give or take, and that's been very, very successful. We know cover calls are not for everybody, but that has been a very good formula and serves the needs of an awful lot of people who like that product, like those attributes, and that they suit them very well.
Yeah, about 2% more yield, 2.5% more yield, give or take, right? You have the averages.
And if you're writing out of the money, you get more upside, you give up some, but people like that trade-off. In the United States, there has been some providers, including Global X, for example, that, and I know you have an interview with Global X coming up, they write on 100%.
Yeah, 100%.
They have huge yields, and the yields bounce around largely, as a result of changes in volatility. But you give up all of your upside. Now they have fixed distribution, so the NAV can still grow because they don't distribute all the premium income and so on. So what we were looking for was to be somewhere in the middle. So when we designed HMAX, we didn't want to do 100, but we wanted something that generated a higher yield than the current generic one. So we said, okay, well, let's keep the parameters completely open. We can write anywhere from 0 to 100. But we really would like to be at the money, not out of the money. So that's important because that means if the market goes up, we're going to underperform.
Right.
So we're going to underperform if the market goes up. It's very important to recognize that. But there's a yield return trade-off, and we are going to get a higher yield because there's a lot of premium income to be had at the money. So in general, we were hoping for, and this was back tested over a 10-year period with lots of different volatility profiles or periods of time, I should say, or levels. We settled in around 13% over time, 50% at the money, gave you somewhere around 13% yield. So we said, okay, let's do that, but we're flexible.
Okay.
So for example, when volatility spiked with all this craziness that we talked about with Silicon Valley Bank, the coverage ratio went down to 35. Because volatility went up, you generate more premium income, you could take the coverage ratio down, which meant that you had more upside in a recovery. It's back up to 50, by the way. So over time, we hope, under the current market circumstances, that we could be, again, using 10 years of back testing, about 50% coverage at the money would get you maybe a low teens yield. And we think that's a good spot. We do feel that we do give ourselves a flexibility that we can take the coverage all the way up to 100 if we want, or all the way down to 0 based on the market circumstances. But what we really want to do is say, okay, we want to give you some upside. It's not going to be as much as a generic covered call ETF in Canada. It's going to be more than what you see in the United States. We're also going to give you a much higher yield, and we're going to pay monthly. So this is a fund for yield, not a growth fund.
Fund for yield. It's in the title.
Yeah,
but it's not 100. It's not. It's right now. It's 50% at the money. Yeah. So it's like you said, it's a bit more aggressive than the current generic ones, but not insane where you're not going to get any upside whatsoever.
Yeah. So if you're looking for growth, we have HCAL. If you don't want leverage and you're bullish, we have HEB. But it's also you can overlay some of these strategies with your market outlook, I should say. So let's say you're listening to this video, you think the market's going to be very tough to down. You're very bearish, on the economy, but you still want exposure to the sector. Then HMAX is probably a good idea for you. And as well, you're a yield investor. If you're super bullish and you think the banks trade at less than 9 times and they're going to 11, you're not going to buy HMAX. You're going to buy HCAL because it's going to do very, very well in a market recovery. And if you're just like, hey, wait a second, I don't know. I think maybe things could be good. I don't want to make I don't want to move too far in either camp. Then we have HEB. So, we are the number 2 provider of Canadian bank ETFs. We have the most solutions, the most products, and we have over $1 billion of AUM in this category.
I love that explanation there. I spend a lot of time trying to educate people in saying that the best doesn't exist. I get the most common question, like, what's the best?
Yeah.
You always see it all the time. There is no best. It's what's best for you. So you guys have three really good options, well, four, including HCA, depending on your
Yes.
outlook, your style, your needs. So, like you said, HMAX is perfect for me because I'm a pessimistic guy. That's
Yeah.
just how I am in nature. Sorry about the banging, got some
No,
construction.
that's okay.
So I like HMAX because I rather get my income now because I don't really know what's going to happen, even though I do have confidence in the Canadian banks.
Hmm.
If you're, I would say, cautiously optimistic, you would go maybe for an HEB, the equal weighted one without the leverage, like you said. Yeah,
Yeah.
I don't really know. If you're an optimist, you would go for the HCAL. You want maximum
Yeah.
growth, maximum total return. So you have the option, like you said, you could even take a hybrid. I tell people all the time, you could take a hybrid approach if you want to. There's nothing wrong with that. But stop
Yeah.
looking for what's the best because you're wasting your time. The best thing is spend your time on figuring out what's best for you. What do you think about
Yeah.
that, Rob? Just in general.
Oh, absolutely. I mean, there's a lot of merit to splitting your allocation between, say, HCAL and HMAX. And by the
Yeah,
way, the yield of HCAL is not exactly,
no
it,
slouch.
yeah, no slouch, exactly. It yields over 7%. And that's also paid monthly. But that's a very good balance. And that fund is extremely popular. Its AUM is safely over 400 million. So I should mention, by the way, HMAX is the Canadian financials, so it does have some of the life goes in it. It's similar.
75% banks, right?
Yeah, it's
20.
75% banks. We tend to talk about it like it is essentially a Canadian bank ETF, but it's 75%. There's 25% of other financials, mostly the life goes.
Yeah, which I like, which do well in a very high interest rate environment. There's also Brookfield, which
Yeah,
is Brookfield, right? Biggest asset manager in Canada. I kind of like that. I like that 75-25. I mean, every single time I look at the market and numbers, the Canadian banks are always, just the Canadian banks always outperform
yeah,
the Canadian market in general. So Canadian
live that
banks are
well.
monsters. They're
Yes,
great
they are.
ones to hold long term. I'm sure you
Yeah,
would agree with that. And Hamilton ETFs has a financials ETF for everyone, depending on their style and their investing objective, your market outlook, like you said. So Rob, that's it for me. I think we covered everything. This is great conversation. As usual, I recommend people, that graphic. It's on your website. Go on
mhm,
Hamilton ETF's website, do your research, look at, the history of the dividend and just figure out
yeah.
what's best for you and don't worry about what everyone else is doing. That's my whole premise. So anything you want to add, my friend, before we drop off?
Oh, not at all. Just we always appreciate the opportunity to speak to your audience, and we very much appreciate and those of members of your audience who invest in our firm and our funds. We don't take that lightly, and we are grateful.
All right, maybe one last point I completely forgot regarding
Sure.
HMAX. I can't believe I forgot this. So it's fairly new. There's three
Mhm.
distributions that have come out. 18 and a half,
Yeah,
18 and a half cents. Latest one was 18 cents. I saw a lot of chatter about this in my community.
yeah,
Very, very small decrease. My estimate, my prediction here, it could vary maybe because
yeah.
it's it's a covered call ETF. It could vary based on volatility. Volatility has been slightly down lately compared to the last 2 months. What would you say? What are your comments on that?
Yeah, so thanks for asking. I forgot to mention it.
I
So
forgot to
again,
mention it too.
what's a generic Canadian covered call ETF, and what are some of these high payout ratio US covered call ETFs? So in Canada, largely covered call ETFs have very stable distributions, gradually rising, but again, don't have the same yield. For the US ones, much higher volatility, a very significant, significant sensitivity to volatility. Over here with us in the middle, or we're trying to be in the middle with HMAX, is that we expect that there will be some volatility at an elevated yield. That it's not likely to be fixed, but our aspiration, our hope, is that the volatility and the variability, excuse me, is very minor. But it's not a fixed distribution. It will move around a little bit, and there will be some sensitivity to volatility. When we launched the fund, we said we wanted the yield to be in the low teens. 13% was what we started off with. Right now it's higher than that. but we think people who buy it should plan, especially if the Canadian banks go up, the yield will come down. But somewhere in the order of 13 should be what your thought process is as it relates to HMAX.
And like we discussed in the last week's video with HYLD, you guys are completely against grinding, right? There's no encroachment of capital with these yields. These yields are very highly sustainable. Correct me if I'm wrong.
Sure. Yeah, I mean, we're doing our best. Yes. So I think we're generating premium income. We're trying to distribute it. And so I think that's fair to say that we are, very focused on having the covered call strategy and the premium income generated be supported by having support, plus the underlying dividends, by the way, supporting the overall distribution. So I think in the main that's that's our goal anyways.
Yeah, and just before we wrap up here, the one thing I want to mention is to the audience, especially people who are newer to covered call ETFs and covered call strategies, you can't think of dividend reductions or dividend fluctuations like dividend stocks, like an AQN, for example, that slashed its dividend. This is completely different. No bank in HMAX has slashed their dividend. That's not why it went down. It's based on volatility. So people need to understand that there's nothing wrong, anything wrong with the companies themselves. It's all based on volatility. It's very important to understand that.
And so, but the other thing that we did, as I alluded to earlier, is we gave ourselves near total flexibility. So the coverage ratio could be 0, it could be 100. So let's say for the sake of discussion, volatility declines. We can increase the coverage ratio to try to generate more premium income to support it. Let's say, for example, volatility went up significantly, like it did in this little mini banking crisis. We brought the coverage ratio, as I mentioned earlier, down to 30, 35. Or let's say we just think the banks are going to be on fire. We can, if we want, bring the coverage ratio down and try to participate more in the rally. So there is an active component to that that is important to highlight.
Yeah, active Horizons ETFs is managing the calls, right?
Yeah, Nick Picard,
and I'm in contact with them. I'm actually doing some videos covering their funds, and I could tell you they just got back to me about this. For all their covered call strategy is an actively managed covered call strategy, unlike a lot of these other ETFs where it's a set in stone. So, like you said, the coverage could go up because if volatility is really high, you don't need to cover as much, and then when volatility goes down, you need to increase a little bit. But the objective of this ETF is really, like the name says, it's yield maximizer, right?
Correct. So you're trying to have a yield fund.
It's a yield fund. It's designed for that. You could expect, like with every other covered call ETFs, everyone, some fluctuations once in a while because of volatility. So yeah, that's perfect. So hopefully that's a good explanation. So it makes complete sense to me. That's it for me, Rob. Anything else you want to add? I think you already did. So
always a pleasure.
We'll see you next time.
Okay, thanks.
Bye-bye. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca. And right there on the homepage on the left hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds. It has sample portfolios for both Canadian investors and American investors. So make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.